Yeah, well, welcome to Share Trek. This is my top 8 picks. I thought I will make this ad hoc video out there to give you an idea of what's on my mind. I'm looking at 8 great shares that I would like to buy now if I had the cash in hand. I think these 8 shares have got a lot of potential. One of them definitely is from our biotech sector. So let's have a quick look at them. And here is the first one. The first one is Alphabet. It's going to have a split on July 2022. And the split ratio is 20 for one stock split. That means if you have one stock right now, you'll get 19 more stocks. All of them will be of the same value. So the current share price will be divided by 20, and that will be the value of each of the shares at that point of time. So the past records for Alphabet on splits is that the last time they underwent such an activity was in 2014, and since then the Alphabet shares have risen over 350%. So if past performance is any indication, there's a good bias for Alphabet shares to grow in price. And over and above that, I have a few more points that I want to talk to you about with regard to Alphabet, which are very bullish factors in my mind. The thing is, Alphabet has got sustained growth possibilities because global digital advertising industry is on track to reach 1 trillion, and Google continues to make incremental growth in the digital advertising market, and it's a leader out there right now. So this means that a sustained increase in income. The other aspect that's very interesting in Google for me is the cloud segment. So the cloud segment is a fast growing portion of Google's revenue. And the cloud is very attractive because it has got some stable large clients. And these clients become sticky once they are platformed onto Google Cloud. So sustained and consistent income is likely to happen with the cloud segment. And cloud would be the future of a great deal of income for Google. And Google has got a lot of stealth projects which might bloom into something huge. In my home, I used to have home automation. I was a home automation buff. So I used a product called Insteon, which had its own server and everything, and you could schedule and time all household appliances and backyard appliances like lawn sprinklers, landscape lights, and everything. But now I find that Insteon is shutting down, and Google product is what I'm using currently. I'm replacing the old Insteon switches with Google compatible switches. So they have a Google automation app, and I bet that it's going to pick up significantly as we go ahead, because more and more builders of condos and new homes are integrating smart appliances and smart controls into their design in order to be more energy efficient. And Google is a lead out there along with its automated systems for voice-based searching and other things. So there's a lot of backward integration possibilities out there. I'm really excited about Google due to that reason. And my next favorite is Tesla. You might have guessed I've been talking about Tesla every now and then, on and off. Apart from being a big fan of Elon Musk and his capability as an entrepreneur, I love Tesla. It's the future of automobiles. It's got a split coming up somewhere in the June-July 2022 time frame, and the split ratio is yet unknown. Past records on splits is that since the 5-for-1 splits in summer of 2020, Tesla has more than doubled in price. So that's the main driving factor behind my thought for going in with Tesla right now. I already have Tesla holdings, but I might increase that whenever there is opportunity. And right now seems to be the best time to dollar cost average more of Tesla. Already consumers are migrating from gas to electric vehicles because of the environmental concern that they had. And now with oil prices being so high, a lot of people who are sitting on the fence are now convinced that they have to go into EVs. And the EV pie is also growing. And there's a lot of government incentives likely to come in shortly in order to encourage uptake of electric vehicles and go to a more green energy kind of environment. And that's where Tesla and other EV companies will gain. And Tesla being on the lead it's likely to gain the most. And it's a breed apart from other EV companies because Tesla's FSD is in an advanced stage of development, and they are also into robotics, and the FSD is most likely to help pilot the robotics also and give them a leapfrog kind of a benefit when it comes to commercializing Tesla bots. And that's another exciting avenue that I think is in store for Tesla. And the big asset for Tesla is a visionary CEO like Elon Musk. This is similar to what Steve Jobs was for Apple. And with mega factories in place before the interest rate hikes, when the interest rates were low, Tesla has already put all those mega factories. So the competition is going to have a higher interest rate regime when they are trying to put those factories. Therefore, the cost competitiveness for Tesla is pretty high. Their cost of production is reduced, and all the mega factories that they have put up now have got the latest technology, which are likely to be state of the art for the near future, and it will be highly efficient. And that gives Tesla an edge on both volumes as well as profitability. And overall, if you had noticed the history of Tesla, regardless of the difficult circumstances, they have outperformed whatever they have promised. And they have always promised mega numbers and outperformed it. So Tesla is another no-brainer for me at this point of time. The third one I have is going to be Noartis. The reason I have selected Noartis is because it's among the forefront of big pharmas that have gone into CRISPR, and they have been building up their cell biology division. Noartis is confident the manufacturing cost of gene therapies will fall as it improves processes and brings on board next generation technologies such as CRISPR and gene editing. And already they are ahead with CAR-T therapy, and they have alliances with some CRISPR companies, and they have also taken over a few pioneering CRISPR companies. Pharmaceutical giant Noartis recently announced a global restructuring that will reportedly include cutting thousands of jobs to optimize costs. And over and above that, they're also weighing the costs and benefits of selling off entire Sandoz sector of the company after already releasing some assets. All of that is towards the goal of cutting around $1 billion in cost. And definitely when those cuts happen, that's going to put Noartis at a much better situation in terms of all its fundamental ratios and with regard to its competitors. So I'm all in for Noartis. And the next one in my checklist is Amazon, which has got a stock split announced at a ratio of 20-1, and that's going to happen on 3rd of June 2022. And anyone who has got a share of Amazon on the 3rd of June is going to end up having 20 shares of Amazon, and they will be 1/20th the value on that date. So overall, your portfolio is not going to suffer, but Amazon shares have gained in the past around 4,300% since their last split on 2nd of September 1999. So that should be a big appetizer for you. And over and above that, I have got a few more reasons why I'm bullish on Amazon. Because in the past, Amazon has shown great capability of managing their logistics. Though Prime deliveries have consistently got delayed during the pandemic, they have still managed to deliver and stay profitable throughout the pandemic. So if anyone can handle supply chain bottlenecks, it is Amazon. They can do the best job of it. Amazon has got the web services division, AWS, which I think is the future revenue generator for Amazon. That's where the most bulk of the growth is going to come after the retail sales has plateaued. This is because they have got big clients, and again, the AWS platform is sticky. Once a client has migrated to AWS, it's going to be rather difficult for them to move off it. This will become a consistent and ongoing income with the ability to increase the price along with inflation and a little bit more and add to the margin. Even though Amazon Prime does not match Netflix, but when you put it along with Amazon deliveries, free Prime deliveries, it makes great value for clients, and also gives an opportunity for Amazon to continue improving Prime videos to be of a caliber to challenge Netflix. So that synergy is also out there. And also Amazon seems to be the go-to place for buying in a competitive marketplace. So if I was looking for something which I don't know where it sells, I'm just going to go to Amazon and I would get 10 or 20 vendors who are selling it. I can compare the price and I can get a free delivery at home. Amazon has made the online shopping so easy that it's kind of generic for online shopping in my books. So because of all those factors, I'm absolutely bullish on Amazon. My next choice is Apple. Apple is top of its game in its product segment, and the design sense and price commanding ability of Apple make it the best investment vehicle in this particular environment with current high interest rate and inflation. So if any company can command price and still have loyal followers, that's going to be Apple. The company has close to 100 billion in annual free cash flow, so this is going to enable it to weather the inflation and the high interest rate environment much better. And also Apple has a habit of giving back to the shareholders, so they will return capital to the shareholders. That's another big factor that I'm thinking about. And also there was a talk about Apple Car, and I think that is still an enticing opportunity, and Apple can very well get into the design aspect of coming up with a luxury car. Whoever may produce it, the Apple brand is going to help them to market it. Right now, Apple phones are produced at Foxconn, so you can have a third-party producer produce everything, but it will be marketed under the Apple brand and with the Apple stores, and that's going to command premium price. So I think Apple is great from that point of view. And the sixth choice of mine is going to be Shopify. It's also going to go for a stock split, which is going to happen in the summer around 22nd of June 2022. It will be a 10-to-1 stock split. So if you had a share of Shopify on 22nd of June, you're going to end up having 10 shares of Shopify. Your portfolio price will remain the same. The price will be divided by 10, and each share will be worth that. And together, your portfolio will retain its value. And I'm very bullish on Shopify because they have made putting an online shop much easy. You wouldn't believe how easy it is. You can decide that you want to have online shop. Just go to Shopify. They can provide you the website. They can provide you the storage. They can provide you an easy to customize shopfront, which you can customize by yourself, and you can put your products online. They have got hundreds of thousands of widgets which allow you to do a lot of function that an online shop needs. It's populated both by Shopify native widget as well as third-party providers. They got integration to drop shippers from whom you can pick up hundreds of products and put up a shop with maybe thousands of products overnight. And it's all well-oiled machinery, and it's the choice for most people to put an online shop. They have got a lot of big companies which have put up shop with them, and it's a sticky platform. Once you put a Shopify platform, once you've gone onto Shopify platform and put a Shopify website, you're least likely to go to anyone else. So it's a fantastic platform, and it's a rival of Amazon, but it approaches online shopping in a different way. And the hundreds and thousands of merchants who are having Shopify shops also do sell on Amazon. So it's a symbiotic relationship rather than competitive relationship, in my opinion. I would bet on Shopify. It's a Canadian darling, and it has been very volatile since its inception, and even now for a company of its size, it has been volatile. But right now, I believe Shopify prices have got stock prices have got compressed a lot. It's a good time to buy and hold for the long run. And all of these choices of mine are long-term choices. They are not for swing trading. They are not for day trading. These are all long-term candidates that I think you should have in your portfolio. Again, this is my personal opinion and not advice. I'm not a financial advisor. Make your own due diligence calculations. Talk to your own financial advisors before investing in any shares. Having said that, my seventh one is FNGU. FNGU is an ETF. It has got an expiry date. I think it will wind up in 2036, if I'm not mistaken. It gives 3x magnification of any gains that you get in the FANG sector. And this is an ETF that holds FANG stocks and has dropped from a high of $50 to $16.61. The strong price rebound is likely to happen once we are past this current market scenario, because its holding consists of companies like Google, Apple, Amazon, Tesla, Nvidia. So it was a no-brainer for me to add FNGU. The price point is also very inexpensive. It may fall a little bit more, but when it bounces back, it's just going to shoot like anything. It's also got Meta in its holdings. So check out FNGU and see if it is something that you would like to invest in. It has got absolute possibility of giving you 3 to 4 times returns. Let us look at SOFI. SOFI is another fast-growing company. It came into the stock market recently, merging into a blank check company. And it has added 523,000 new customers in the last 3 months of 2021. So that's its credential. And since then, it has advertised in the Super Bowl, which took place in the SoFi Stadium. So they got pretty good muscle, and they're putting their marketing money in the right place. And it appeals to more of the younger customers who are going to be the future of banking customers. And their banking platform, which is a unified smartphone app, resonates very well with the younger generation. And it's very well likely poised for growth. And apart from that, they also recently took over another major transaction company, which was called Galileo Financial Technologies. It's a digital payment platform that enables its own checking and savings account functionality. SoFi took them over for $1.2 billion in 2020, and it has enabled it to have many B2B customers like Robinhood, for example. And this provides a great deal of heft for SoFi, in my opinion. And it's only going to grow as the time goes by. We'll be past this current term of bearishness in the market, and there is light at the end of the tunnel. And when that happens, SoFi is likely to multiply at least twice in value. And those are my 8 picks for right now in this current market environment, with a long-term emphasis. This is not for day trading. This is not for swing trading. This is for building a bulk of your portfolio and giving it a foundation. So I'm going to be doing this whenever I get an opportunity. And I hope you liked this video. If you did, please do not forget to press a like there. It will enable more users in YouTube discover our channel and this video. And if you are already subscribed, I thank you for that. And if you haven't, why not? Please press the subscribe button and join our community. And you will have wonderful information on CRISPR-related stocks, CRISPR-related topics, and also other interesting stock market topics like the one that I did today. So thanks for viewing this video. Have a wonderful weekend. I'll see you tomorrow. Bye for now.